So let's get things underway. Here now on today's topic is Doug Austin. Doug, take it away.
Well, welcome everybody. We're glad you're here and took the time to join us today. We're excited to have Aaron Kerrigan. Aaron is a founder and managing partner of Kerrigan Advisors. As you know, they're the leading sell-side advisor for automotive space and focus on a lot of larger transactions. So in this challenging time that dealers are dealing with today, I think this is certainly a pertinent and opportune time to hear what Aaron has to say. This has been, we started this webinar series about a year ago, May. We run these about every 2 weeks, ideally, and we try to focus on expense categories, audit and recovery opportunities, or new opportunities available to dealerships to help them manage more effectively and ultimately improve their bottom line. So we're glad to have Erin today. She'll take you through this information, and then I'll wrap up at the end, and we'll tell you how we can make this information available to you. Take it away, Erin.
Okay, well, thank you very much for this opportunity. Well, it's wonderful to be here, and I appreciate the opportunity to talk about something that's certainly near and dear to everyone's heart, which of course is valuation. One of the questions that we're getting a lot these days is, where is blue sky today, and is it in fact peaking? And while I certainly do not have a crystal ball that can perfectly answer that question, throughout my presentation today, you're going to see that I'm going to provide a lot of data that will help, frankly, all of us on the line and myself to come to as close a conclusion as we can, or at least be better informed as we look at the buy-sell market and valuation. Now, given the time of year, I thought it only appropriate, you'll see, to employ a college football theme to today's webinar. There's certainly a lot of similarities that I see between college football and the buy-sell market, including determining blue sky can be as challenging as predicting the winner or loser of one of these games, as it was a few weekends ago when Notre Dame lost to Marshall at home. Sorry for the Irish fans out there, by the way, including my family. My husband and son attended the university. But this picture does perfectly elucidate the point that it is hard to predict where the markets are going to go. Now, unlike Notre Dame football, the 22 buy-sell market did get off to a great start with 167 transactions completed in the first half of the year. And that's a 16% increase relative to the first half of last year. On a trailing 12-month basis, we had 406 transactions through June, surpassing 21's 12-month record. Now, based on Kerrigan Advisors' current activity, we expect the number of buy sells to remain high through this year and into 23. And looking at this data, it is quite clear that our industry does continue to consolidate in a meaningful way. And by the way, that consolidation is pretty widespread, with every single state seeing an uptick in transaction activity, particularly high growth states with business-friendly practices such as Texas, Florida, Utah, and Colorado. Colorado, by way of example, led the consolidation movement last year with 17% of its dealerships selling, including our large clients, the Stevenson Automotive Group, which was the largest private group in Denver. If this pace of activity continued, nearly every dealership in Colorado would sell in less than 6 years, leaving the state with just a handful of owners. And even if the pace had continued throughout the entire country, 21's pace, you really would see the industry almost fully consolidated in the next 25 years. So this consolidation movement is quite significant. Now, despite negative economic headlines and certainly an extremely volatile stock market, the auto retail industry does remain focused on expansion by acquisition, particularly as profits continue to rise. Through the first half of 22, Our firm estimates the industry earned $4.3 million on a rolling 12-month basis, and that's a 207% increase from the pre-pandemic average. Now, rising earnings have resulted in nearly a twofold increase in blue sky values, average blue sky values, as compared to pre-pandemic levels for the average dealership. Now, with industry entering into its third year of these historically high profits, what we're finding is buyers and sellers are really grappling with how best to value a dealership. While most dealers agree a return to pre-pandemic operating margins is unlikely, few have great clarity about where the new normal will settle once inventory levels rebound. Projections are particularly challenging given all of the change on the horizon, including electric vehicle sales, agency models, online sales, as well as the near-term risk of recession and, frankly, new entrants like Tesla and Rivian taking market share. Towards the end of this webinar, I'm going to discuss how the market is grappling with this blue sky value conundrum. Now, one highly positive factor that continues to drive buy-sell activity and valuation is the tremendous rise in dealer liquidity since 2020. Today, dealerships' balance sheets are literally flush with cash, with current assets nearly double current liabilities, a 50% improvement from where we were before the pandemic, and debt-to-equity ratios now at all-time lows of just 0.72. With these kind of fortress balance sheets, most dealers are looking to capitalize on their financial strength and redeploy their profits back into the industry they know and love, resulting in more demand than supply for dealerships on the market today, which is exactly what we found in our 21 dealer survey. With over 600 dealers responding, 77% indicated they plan to add one or more franchises, and just 3% are looking to sell one or more. We will soon be publishing our results for our 22 survey next month, and the results are largely the same. The majority of dealers are buyers, not sellers. So those seeking to acquire dealerships are highly aware of why our industry is so great. Our average return on equity for our dealerships now is over 55%, according to NADA. Many auto dealers believe there are few private investments available that can provide this kind of risk-adjusted return that we get in our industry. In fact, some dealers who plan to sell in the near term are sharing with us that they're just going to hold off today because they realize they may get a lower blue sky multiple in the future, but they're willing to take the risk and accept that, knowing that they're making so much money currently and that few buyers today are willing to pay them a multiple on these record earnings. So they're just going to continue to reap the tremendous earnings. And then when the time is right to sell, they'll sell, and maybe they will have lower blue sky values, but they think relative to the current cash flow, it's a risk they're willing to take. And I literally have that conversation all the time with dealers. Now, while the industry continues to post tremendous profits, there are signs that auto retail may be approaching an earnings tipping point as the impact of record inflation coupled with rising interest rates, which of course went up again yesterday, begin to take an economic toll on the car buying consumer. Notably, in June 22, while inventory levels declined 21% compared to 21, days supply actually increased 24%, rising above prior year's levels for the very first time, by the way, since the start of the pandemic. Consumers are also increasingly tapping into their savings as well as borrowing more to sustain their spending. In fact, both of these metrics, consumer borrowing and savings, have deteriorated to 19 levels, with revolving debt now near all-time highs and consumer savings plummeting from over 25% to just under 5%. We also, in the Journal, reported last week that we're seeing higher amounts of withdrawals of bank accounts, and the deposits are hitting all-time lows for some of the banks. So also another sign of liquidity for the consumer not being as strong as it was. Rising prices and economic concerns have caused consumer sentiment to decline to the lowest level on record since the index initiated in 1952. And as you can see on this graph, historically, U.S. new vehicle SAAR is highly correlated with consumer sentiment. So while today's low SAAR is for sure primarily a result of limited supply, the rise in day supply in June may be an indication of weakening consumer demand and a harbinger for a lower new vehicle sales rate even after inventory availability does rebound. Wall Street is certainly reflecting some of these risk factors. Year to date through August, the Kerrigan index of the 7 publicly traded auto retailers was down 17.6%, underperforming the S&P 500 by 3.3%. And while the index remains 37% higher than pre-pandemic levels, the valuation declines year to date are notable, particularly given the record second quarter profits posted by the publics. In fact, the public's average blue sky multiple on current earnings is now at a paltry 3.4 times and at a 7-year low. Valuation multiples reflect investors' growth expectations for the earnings of a particular stock. At the height of the pandemic in 2020, Wall Street correctly expected high earnings growth in subsequent years. In 22, investors are messaging that today's record earnings are potentially unsustainable and are thus expecting lower future earnings when valuing these stocks. Now, as a result of this, after a groundbreaking 21, U.S. public auto retailers' acquisition spending in the first half of 22 declined by $1 billion, a 49% reduction from the first half of 21. And these companies are now tracking to just $2 billion in spending, less than a quarter of what they spent last year. Now, $2 billion, if you look back historically, would still be a lot relative to their peak spending before the pandemic, but much, much less than what they were spending in 21. Simply put, the publics are really finding that they're getting to some degree priced out. And you can see the public saw their share of the buy-sell market decline to just 9% of transactions in the first half of the year. And that is a dramatic reversal from dominating the buy-sell market at 29% of transactions in 21. Because of their lower stock price, what we're seeing is in the first half of the year, these companies had tons of money. You know, they had record earnings, but they're allocating their cash flow to buying back their own stock because they can buy it at a 3.4 blue sky multiple instead of going and buying dealerships. So if you look at the first half of 21, they allocated about half of their cash flow to U.S. dealership acquisitions. And that's reverse in the first half of 22. They've allocated about half of their capital to buying back their own stock. It is important for us to remember that for an acquisition to be accretive to a public company's earnings, the multiple they pay must be lower than the multiple at which they trade. At their current multiples, many of the publics are simply the multiples are too high, and these deals would be dilutive to their earnings per share. Since these companies are the most well-funded of the major acquirers, changes in their valuation multiples and their buying patterns do have a direct implication on the buy-sell market, particularly for larger groups, which interestingly saw a decline in the first half of 22. So even though transaction activity was up overall, transaction activity for multi-dealerships groups was actually down 18% in the first half. And we attribute this decline directly to the decline in the public dealership group spending, because they often are the biggest players when it comes to buying dealership groups. Now, with rising interest rates, it is important to remember there is a clear inverse relationship between interest rates and the value of any business. And you'll see that interest rates in particular are most sensitive to larger transactions because those transactions tend to use the most amount of leverage and therefore are more sensitive to the financial markets. I like to say that the biggest indicator of the value of a dealership, especially more valuable dealerships, is the interest rate environment in which it is sold. This is best evidence, the valuation implication of interest rates is best evidence in this graph. Well, you'll see the inverse relationship between a public company stock price relative to its bond yield. So you can see that as AutoNation's bond yield historically goes up, its stock price has declined. And there's no different than what we see in the private sector. As interest rates rise, acquisition financing gets more expensive and harder to come by, and blue sky values usually eventually go down because buyers' return on investment requirements go up. The old adage, don't fight the Fed, could never be more true. With inflation running now and continuing at a 40-year high and the Fed raising interest rates and indicating they're going to keep doing so, this concept that you don't want to be investing against a rising Fed is certainly one to take note. We believe blue sky values will probably not rise much from where we sit today if interest rates do continue on the path that they're on, and we could see a decline in blue sky values if the Fed does take rates too far, which it seems they may be willing to do. Now, I'd like to close out this webinar with what we see as the biggest challenge in today's buy-sell market, and I hinted at it at the beginning, and that is determining blue sky value. Now, auto retail entered its third year this year of record profitability, and that it will last throughout the year. Few dealers predicted the longevity of today's historic earnings rate. The challenge many now face is how best to value a dealership, given most dealerships are on pace, again, to replicate 21's record. Now, as a reminder, most companies, including dealerships, are valued based on their expected future earnings. Commonly, buyers calculate that by looking at the average of the last 3 years' profits as a good proxy for future expectations. Buyers will then apply a blue sky multiple to that average to determine a blue sky purchase price. Well, at the end of this year, which is quickly approaching, if 22's current run rate continues, the industry is on track to earn an average per dealership of $3.5 million. And that would be again what we would expect at the end of this year. That's 150% higher than the pre-pandemic averages, as you can see on this chart. The question, of course, is that a good proxy now for the future, especially in the rising interest rate environment? And herein lies really the challenge that buyers and sellers are grappling with. From a seller's perspective, the last 3 years of elevated earnings may be more sustainable than originally thought. Experts predict the market for new vehicles will be undersupplied for years due to continued challenges in the supply chain and multiple years of pent-up consumer demand. Others expect the OEMs will, in fact, avoid oversupplying the market in the future, particularly as they're shifting to a more online sales and ordering electric vehicles, and instead target at most a 30-day supply of vehicles. These dealers point to the OEM's record profitability in 21 as a result of having less vehicle supply and lower incentive spending in so doing. Now, in contrast to the seller's perspective, some buyers are concerned the industry will in fact revert back to the pre-pandemic earnings once chip availability rebounds, whenever that is, and the supply chain improves. These buyers believe most OEMs will weaken their resolve and once again compete for market share by overproducing vehicles and incentivizing customers. In so doing, the OEMs could recreate the historically low new vehicle margin that we saw pre-pandemic and reverse the tremendous appreciation experienced over the last 3 years. Some of these buyers are also skeptical about the sustainability of recent operational efficiencies at the dealership level, particularly given current wage inflation. Many expect to see expenses rise in the future as the industry shifts back from this taking order mentality to actually having to sell vehicles and maintain inventory. Now, all of this being said, these buyers are also keenly aware of their need to grow in order to achieve the scale required to successfully navigate potentially dramatic industry evolution in the future. Scale has certainly become a key strategic imperative, particularly for smaller dealer groups. These buyers understand the longer dealership earnings defy historical expectations, the harder it is for sellers to justify a sale price based on anything but post-pandemic numbers. So if you want to grow, there is this sort of sense you got to pay to play, and maybe you do need to accept larger valuations and assume you can sustain some of this high level. Now, interestingly, this methodology of using the last 3 years of earnings as a benchmark for future profits is consistent with the way Wall Street is valuing public dealer groups on their current blue sky values. We went back and we looked at the 3-year averages for all of the publics. We took all of their earnings collectively and did it on a TTM, so a trailing 12-month basis for June 2020, June 21, and June 22. We averaged those 3 years' earnings. We took their total blue sky value today, which is 27 billion, is our estimate for all the companies, divided it by their average 3 years of earnings before interest and taxes, and we get to a 5.3 blue sky multiple, which, if, by the way, we apply our liquidity discount, which you apply to public multiples relative to private multiples, because we don't have a liquid stock in our private dealerships, you get to it almost exactly what the average blue sky multiple is as published in our blue sky report. So there is some consistency here with the way we're thinking about it and the way the highly efficient public markets are thinking about it. My final comments today are regarding franchise blue sky market share and specific multiples. As you can see, since 21, imports have grown their share of the buy-sell market quite impressively relative to their franchise share of just 34%. So the pie graph on the right is their franchise share, and the bar charts are their buy-sell market share. Kerrigan Advisors attributes the weakness in domestic buy-sell market share to waning buyer demand for certain domestic franchises due to concerns regarding future dealership business models. Many dealers are concerned, even after Ford's meeting last week, about Ford's significant changes that they are rolling out related to how they're going to retail their electric vehicles. When we look at what drives franchise value, we do find it is primarily throughput and expected future earnings. OEMs who maintain a high level of sales per franchise usually command the highest blue sky multiple, with Toyota leading the pack in the non-luxury segment and Lexus in the luxury. Dealerships in this upper right-hand quadrant operate with a much more stable and profitable business model, one with high UIO counts leading to stronger fixed operations and typically more used vehicle trade-ins, which enhances dealers' lucrative used vehicle business. While throughput is the key to franchise value, there are exceptions to this rule. In the case of Porsche and JLR, these franchises make up for what they don't have in volume with their incredible new vehicle margins and strong consumer demand for their unique products. The other exception are those franchises that have seen their sales per franchise greatly improve over the last few years despite the pandemic. And these, of course, are the ones that I just highlighted here: Hyundai, Kia, Nissan, and Audi. These franchises have the potential to move towards the upper right-hand quadrant if they continue to grow sales at their current pace without adding franchises. The remaining franchises in the bottom left quadrant have lower sales per franchise and thus lower multiples. The value of these dealerships typically lies in their operator or their location rather than the franchise on the door. For instance, a bottom left quadrant franchise located in Austin, Texas will command a much higher multiple, not because of the franchise, but because of the location. As we look at this graph, it is quite clear that the imports currently have a much stronger business model than the domestics. But of course, we know all of this could change because we certainly see a lot of change on the horizon in our industry. To finish up today and continuing with the college football theme, while it is certainly unclear whether blue sky values have peaked at this very time, it is clear that dealers are having a lot more fun than they were before the pandemic. The rising tide of industry profits is lifting all boats and making auto retail a winning game again. Lou Holtz, the legendary coach from Notre Dame, said how you respond to the challenges in the in the second half will determine what you become after the game, whether you are a winner or a loser. I would say we are likely entering the second half of this tremendous period of record earnings. How you manage your dealerships as we come out of this period will have big implications on your win-loss ratio, particularly as you navigate the changes coming to auto retail. I am confident most dealers will find their way to a win. Thank you very much, Strategic Source, for this opportunity. And I am happy now to answer any questions that anyone has. And I will put my video back on.
Okay, thanks, Erin. Thanks for going back live on your camera. And Doug, if you can activate yours too. And we are now ready for questions. Everyone, you can type something in with the Q&A button at the bottom of your screen. We'll be monitoring that for as many as we can answer. And let's begin with this question here. Erin?
Sure. Based on recent Ford announcements regarding dealer facility upgrade requirements for Model E, how will that affect blue sky multiples for Ford's dealerships? So we're going to be publishing next month, as I hinted at, our annual dealer survey in which we have over 600 dealers respond, and we ask where do you think the value of each franchise will go in the next 12 months? Will it increase, stay the same, or decrease? And not to have a spoiler alert, but it's a pretty dramatic negative on Ford. I think that's to some degree, again, getting to the point that I elucidated in this webinar of businesses' values based on your expected future earnings of the buyer. And when you have changes to the business model, it's harder to project that. And so I think that's partly what's the cause. It's going to be quite interesting because if you are a dealer that does not opt into the electric vehicle, you don't spend the whatever it is, 1.2 million or 500,000, then you're really your whole business is predicated on, at least for this time period, unless you do it in the future, is predicated on the ICE business. And that's going to be a business that Ford's investing less in. So that I would think would have a negative effect on the multiple. If you do sign up for the full board, I think that will have a positive effect, but it has to make economic sense. I mean, we have a client right now that said, look, I just don't sell these vehicles. I'm not in a market that people buy electric vehicles. So it makes no sense for me to sign up for this. There's a lot of questions certainly about the changes to the model. And again, whenever there's change, it makes it hard to predict. Now, one thing, I'm just going to answer one other question, which is, how in general is electrification affecting the blue sky values? Until this very concrete discussion from Ford, everything else is pretty amorphous, right? The OEMs are coming out with big numbers, but no one really totally believes them. And so we haven't seen any effect on all these electrification announcements. I think this, now that Ford is getting more granular, you're going to start seeing some effect, because it's going to affect the projected earnings for the future, and certainly with their limiting also the pricing on this and the margins on the sale of these vehicles. The next question is, any potential manufacturers that are more aggressive moving to sell direct model? I mean, I think that all of the OEMs are pretty clear that they feel they need the dealers. It's the franchise laws are pretty amazing, and they really do protect the franchise. So at this juncture, I think it's pretty unlikely you're going to see like truly the OEM selling direct to the consumer. That being said, I think they're going to try and have and every dealer I talk to is experiencing this. They're going to want a relationship with the consumer. So, they may not be the one selling direct, but they're going to want to know everything about the consumer. And I think that's where there's going to be a lot of state regulations coming down the pike. I mean, state associations, if you ask me, should be working their tail off, because we're going to need them to protect the investments that every dealer's made in their franchise, to ensure that, especially as it relates to buy sells. I mean, I'm seeing the OEMs be pretty flagrant in their efforts to manipulate the buy sell market, which is not beneficial to the dealer, because it effectively means they will when they manipulate the free market for dealership values, they dampen the value.
I see a question here that has come in. Again, you can click on that Q&A button to ask a question for Erin. Here it is. What kind of premium are you seeing in Texas and Florida?
So we actually typically see 1 to 2 multiples higher than our highest published multiple. And if you read the preamble before our Blue Sky report that goes into what drives, we always say that the multiples we publish are really benchmarks, but there are lots of reasons where we see multiples higher or lower than what we publish. And one of them is location. So, given the influx of population to those states, just the simple UIO count per dealership is growing. And so effectively the most lucrative part of dealers' businesses, historically, their fixed ops, are growing without them doing anything, without them selling another car. That rising population is driving valuations higher, on top of the fact that both those states we have no state income tax, very business friendly. And so we really do see, and there's so much demand for dealerships in Texas and Florida, that we really do see their Blue Sky multiple typically 1 to 2 times higher than our highest published multiple. Can you clarify how the OEMs are manipulating the buy-sell market? Yeah, so they're actively exercising their right of first refusal. And when they do that to an extreme, that inherently a buyer is more hesitant. You can't get buyers excited about a franchise if the buyer's like, well, I don't even want to make an offer, because the OEM is just going to determine who's the buyer. I have an opportunity cost of my time. So I'm not going to make an offer. Mercedes, by way of example, announced to all their dealers, look, just come to us. We'd like to pick your buyers. And they are ROFRing almost every deal. So they're trying to say, like, we're in control. We want to control who are our dealers. And we recently had an example, and I won't say which OEM, but we submitted the buy sell, and the OEM literally came to the dealer and was like, yeah, we'd like you to consider this buyer. And it like the buy sell agreement was a suggestion and hadn't required months of planning and timing and marketing and getting to the highest clearing price. And so, I think what you're seeing is, especially as you look at the framework agreements, they're increasingly requiring of the most, the folks that are buying the most are now under these extreme framework agreements. Oftentimes those framework agreements are actually in violation of state franchise law, but that leaves the buyer, the aggressive buyers, with a conundrum, right? They know that they can technically buy a franchise in whatever state, and the OEM can't not approve it, but they'll be in violation of a framework agreement. And so that's another way where they are really skirting around the franchise laws of each state.
I don't see any further questions. Oh, actually, go ahead. Aaron, I see another one has come in.
What short-term operational activities should a dealer engage in now to the greatest impact on improving their value for a potential sale? So, I will say the biggest driver of your value is the market you sell into. And I've seen this so many times. In fact, I have a current client that wanted a few more months of these great earnings before they went to market. Well, of course, now interest rates went up and they're trying to top tick the market. And they frankly would have been better off 6 months ago going to market and gotten a higher value and had more excitement about it. Because now with interest rates going up, there is some pullback a little bit on valuation. And it's not as easy to do what we're successful at doing, which is pushing buyers to their highest price. So there are things you can certainly do to improve your business, but the market in which you sell is going to have a bigger impact on the value of your business than these incremental things you do to your earnings. That being said, what I would say, if you're thinking, 10 years from now, it is a really good, consistent earnings, consistently growing earnings that don't have a lot of, add backs and manipulation or changes in accounting. I mean, you want to see consistency, but the less you have to explain things, the better your value is, I would say, across the board. Oh goodness, lots of questions. What do you see for normalizing of day supply when supply issues level? Look, I think everyone hopes for 30 days. Unfortunately, there's certain OEMs right now, I've been told, that are already at 60 days, but I think everyone hopes for 30 days Toyota said that's what they're planning on. How are you seeing CapEx facility requirements affect Blue Sky? Is there a one-to-one discount? There's not a one-to-one discount. So facility, the way facility requirements typically affect Blue Sky is if a buyer is buying the real estate, and by the way, if they have to do a facility improvement and invest in the real estate, they're going to insist on buying the real estate. And they have to, make a $1 million investment. The buyer is going to project that their rent goes up. So it's not, oh, I invest $1 million takes off the Blue Sky. Those are apples and oranges. They're investing $1 million in the real estate. That means their future rent increases. So that will have going back to the concept that buyers are paying what they expect to earn. So they're going to expect to have a higher rent rate. Now they could expect to see more sales, although we all know facilities don't sell cars. But if it was service and they thought they were going to have more service because they need more base, then it probably shouldn't have any effect on the Blue Sky. But if it's truly just, decorative requirement of the OEM, then both the near-term disruption of doing the improvement, that'll affect future earnings, and the higher expense of rent, that probably has a dampening on expected future earnings and therefore a dampening on Blue Sky, but it's not a one-to-one ratio.
I see no further questions here, but we will leave the Q&A box up here for a little while longer. What I wanted to do, Doug, before conclude the session is I'm just going to bring up the post-session survey that we can get people's input before they have to depart. So let me bring that up, and then I'll turn it over to you for closing out. All right, Doug, you can take the rest of the way.
Okay. Well, Aaron, thank you very much for your presentation today. It was certainly rich in data and insights and trends. I think you've outlined a pretty positive environment for dealers right now, but the question is if that will change and when will it change if it does. And I think you've given folks a lot of data points to consider in that equation. So, Aaron, thank you for your time and
Thank you.
Wonderful presentation. It's been very helpful.
Thank you.
As you look at your dealer operation, if you're trying to improve your labor situation, if you're trying to improve the reduction in expenses, well, Strategic Source is in a great position here to help you, and we'd like to do that. Reach out to us at sales@strategicsource.com if you want more information, and we'll be happy to provide this presentation to you if you'd like. It will also be up on our website probably by tomorrow sometime, so you can access it there. And we will certainly make it available to all of our clients through emails as well. But if you're looking for help on the expense side, audit side, even increasing new revenues through other opportunities, we're here to help you. And just reach out to us. And if you can call us at 612-386-3898. Reach out to us at sales@strategicsource.com. That's all I have. Thank you for joining us today, and keep an eye on your emails. We'll be running these, and we have run these webinars probably every 2 weeks. So there'll be other topics that we will discuss that will be of interest to you as well. Thank you.
All right. Thank you, Aaron. Thank you, Doug. And thank you, everyone, for attending. And we look forward to you joining us on future webinars with Strategic Source. Have a great rest of the week, everyone.